Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hi everyone, this is Yazad. Thank you very much for being here today. When it comes to investing, there are many options for an investor to choose from. There is investing based on fundamentals, then there is investing based on technical parameters. And looking at investment strategies, we have a gamut of investing methods such as value investing, growth investing, momentum investing, dividend investing, passive investing. The list goes on and on. And then of course we have experts, gurus, YouTubers and a whole bunch of people dishing out their opinions and advice on what is the best strategy or stock to buy or sell. Unfortunately, we live in a society where there is an information overload. This presents an enormous amount of irrelevant and biased data to investors that leaves them often confused and unable to reach any decision. And the current market situation has left most investors anxious and groping for answers. People don't like uncertainty when it comes to finances, and that is exactly what we have experienced in the markets thus far in 2022. But amongst all this noise, there is one method, the Canslim strategy, which stands out simply because it is based on facts and figures. Canslim was developed by William O'Neill in the 1950s and has ever since been one of the most widely studied investment methodologies over the world. Canslim is a techno-fundamental strategy that helps one pick quality stocks focused on companies that show acceleration in earnings. The method was named the top-performing investment strategy from 1998 to 2009 by the American Association of Individual Investors. The Canslim method to pick stocks. As with almost any stock trading strategy, the goal of Canslim is to help investors in finding stocks that have the potential to outperform the overall market and other stocks in the same industry. One of the key differences of this strategy as compared to others is that it uses both technical analysis and fundamental analysis criteria. This combination of technical and fundamental analysis can be a game changer, since the technical aspect of the strategy could help provide attractive entry and exit points, while the fundamental study is used to evaluate the company based on its financial performance. And this is what makes Canslim considerably better than other methods when it comes to performance in terms of returns. O'Neill looked into the past and analyzed different market winners since the 1880s that had outperformed the markets. He identified 7 common traits that occurred over and over again in almost all top-performing companies, which could signal a stock to go on to make massive gains in the future. These 7 common traits are what Canslim embodies, and it is still as relevant to markets today. Canslim is a stock selection process that could help you identify the next Bajaj Finance, HDFC Bank, or even the next Apple, and it could allow you to make a significant amount of wealth. The word Canslim is an acronym for a 7-step process or a set of 7 rules that an investor is supposed to follow to pick quality stocks with very high growth potential in the future. Let us start off by taking a brief look at each of the letters and how it identifies the criteria for picking a top quality stock. C stands for current quarterly earnings of a firm. Growth of at least 25% is a good starting point. Investors should ideally compare the current quarterly earnings per share figure of a company with that of the same quarter in the previous financial year. Additionally, investors should look for earnings acceleration over the last 3 quarters. A company with high earnings per share growth means that the company is both profitable and fast growing. A stands for annual earnings growth. The method emphasizes that a company's revenue and annual earnings should grow at least 25% for the past 3 years. The annual earnings requirement seeks to find stocks that not only have strong earnings, but that are using those earnings well. According to the Canslim method, ROE must exceed 17%. N stands for new product, service or management. N refers to the idea that a company should have continuing development and innovation. Companies need something new to drive the sort of growth required for Canslim companies. It could be a new product, new service, new pricing, or even hiring a new CEO. A good example of this is Apple with the iPhone, or Reliance with Jio, or even Tata Motors with its aggressive push into electric vehicles. S stands for supply and demand. From a technical perspective, investors should look out for a sharp increase in a buy point. A buy point is typically when a stock is just exiting its lows or after a consolidation. A good example of this is the cup and handle pattern. Fundamentally, supply and demand refer to purchase of shares as compared to the total shares available in the market. Investors should look for stocks with fewer shares outstanding, as these stocks can perform well since the supply is restricted. One should look for stocks which see heavy accumulation by institutional investors, especially at levels where the stock is breaking the prior resistance levels. A company that buys back its shares from the market automatically reduces supply of its own stock, thereby creating additional demand and subsequently a rise in the price. A case in point is Tata Consultancy Services Limited, which has announced 4 buybacks over the last 5 years. L stands for leader or laggard. O'Neill suggests buying the leading stock in a leading industry. The idea here is to distinguish the leaders from the laggards. Leaders can be spotted through relative price performance. If a stock's 52-week relative price strength rating outperforms 80% of the market, then it is a good bet that it is a market leader. The I stands for institutional sponsorship. A company must have some institutional investors as shareholders. The institutional sponsorship could include mutual funds, insurance companies, pension funds, or other institutional investors. Any recent increase in the level of institutional shareholding is generally viewed as a positive factor. Large purchases or bulk deals by institutional investors are easy to spot if you happen to look for abnormally large volumes when a stock is coming through a breakout point. However, the institutional holding should not be too large either, as any bad news would lead to heavy selling. Finally, the M in Canslim stands for market direction. The final criteria of the method considers the general market direction. Most companies tend to follow the current direction or trend of the market. An investor should analyze the broader market movements before deciding to invest in a company, as 3 out of 4 stocks tend to follow the general market direction. Now that sums up the 7 rules for identifying the next big winners of the market using the Canslim strategy. Here are 15 stocks identified by using the Canslim method. These are 15 stocks that meet the criteria on the basis of growth in sales, year-on-year quarterly growth, profit growth over 3 years, return on equity, etc. These are just some of the stocks identified using this strategy. You too can do your research on various other stocks using these parameters and dig in deeper and come up with your own lists and track the same. The Canslim method is based on simple, straightforward rules, mixing the fundamental and technical aspects of trade to arrive at identifying the right stock. As an investor, one is always looking to pick up stocks at the right price. Often in this quest to buy a stock that is available cheap, investors look towards the PE ratio with the assumption that it is a good indicator for an entry point. But there may be a good reason for stocks available at a lower price, just like a higher PE stock may be trading at a premium for a good reason. Canslim, on the other hand, is a more comprehensive method to identify the right stocks, as it tries to balance fundamental and technical analysis with momentum investing principles. As the stocks are identified through an extensive data-backed process, these stocks can provide good returns to investors. It helps investors identify companies with solid growth and a strong business model, while at the same time it is sensitive to price movements and actions of other large investors in the market. The strategy works best in fast markets having high levels of volatility, such as the current market, as Canslim buys high beta and high growth stocks, which typically do best when the markets are still bullish. Canslim can be a great strategy for experienced investors having higher risk tolerance, as the stocks identified using it cannot just be bought and held. The idea is to invest in high growth stocks before large funds and institutional investors have finished their buys. This is because there is a lot of emphasis on very high growth going forward, and if there is any slowdown in the company's growth, or the market as a whole, it would result in a significant fall in price of such stocks. It should be explicitly clear to investors that each rule of the 7-letter acronym Canslim denotes that this strategy is designed to identify the best growth stocks and not value stocks. That's all we have for you this week. Thank you very much for watching. Hope you like this video and it helps you in your investing journey. Thanks for watching. Happy investing. Goodbye.